My 3 ETF portfolio is the simplest and best way for anyone to get rich. By backtesting this portfolio versus the Warren Buffett portfolio and the Rick Ferri portfolio, had you invested $1 million in each one 10 years ago, you'd have $3,558,351 in the Ferri portfolio. You'd have $4,338,861 by going with Warren Buffett's pick. And if you went with the Professor G 3 fund portfolio, your $1 million would have turned into $5,033,126. Looking at the chart here, it's easy to see that my portfolio crushed the other two as mine is in red. Looking at each year's annual returns, it's easy to see that my portfolio had much higher highs for most of the years, but what I like most is that in the worst year for the entire market, my portfolio did less bad than the rest. Which means that with my portfolio, you're gonna get the highest highs during a bull market, but then when things crash, this one's gonna actually keep you very, very safe. If you've been following this channel for any period of time, then you know that my 3-fund portfolio consists of one foundational or broad indexed ETF, something like VOO or VTI. The next ETF in the portfolio is one dividend fund, and my favorite for that is SCHD. The last piece of the puzzle is a growth ETF, and for that I do like a couple of them, but my favorite right now is QQQM. So Harrison submitted a very solid question, and he asked, you break your investing into 3 categories of ETFs, but are you investing in multiple different ETFs under each one of these categories? This is a great question and one that I'm very happy to go over. And if you have any questions or anything that you've thought of over the last week or two looking at different videos, something that you'd like me to possibly cover as a topic, go ahead and put that in the comment section down below and maybe you'll see a video on that in the near future. I'm Professor G and I made this channel to make investing simplified. So let's dive into this topic of how to best invest into these ETFs to build out the ultimate portfolio. In its absolute simplest form, my 3-fund portfolio was meant to have one ETF for each category. Purely for simplicity's sake, but also, as you saw at the beginning of this video, having each one of those 3 and only having 3 ETFs might be the best way for most people to just invest in general. But by investing in only one ETF for each category, there is a problem. By investing in that one ETF, you may feel like you're missing out on what a different ETF that's very, very similar has to offer. Maybe it's the type of companies that are within the fund or even the structure of how much of each type of company is in. But at the end of the day, it may just be stressing you out, wondering if you've made the right decision. If you listen to certain YouTubers or finance bros, they may tell you that investing in very, very similar ETFs is so bad, and that's because of this thing called fund overlap. And fund overlap, again, is just the percentage of which overlaps between the 2 ETFs. So if you have a fund that's comprised of all large cap US stocks, something like VOO, and a fund that's comprised of companies in the technology sector like VGT, you'll see that the overlap is only 31% by weight. This is relatively low, and by holding both of these funds, you're investing enough in dissimilar things. For 2 broad index funds like VOO and VTI, you'll see that the overlap here is 85%, which basically means that you're investing in almost the same thing, just in 2 different places. But this isn't necessarily negative or wrong. I'll show you how you can do it correctly so that you can have any ETF that you want, even if they're similar, within your portfolio. So in this video, I go over how much of each ETF or each ETF category you should have within your portfolio by age. It differs if you're 20 versus if you're 35 versus if you're 55. So check out that video after this one, and I'll link it down below, because this video today and that one together is going to really, really get you started strong. Remember that the 3 categories are foundational, dividend, and growth. So once you figure out how much percentage of each one of those 3 you want to comprise your total portfolio, then you can get started. For this video and this example today, we're going to go with 40% foundational, 40% dividend, and 20% growth. So let's start with foundational. What matters here is that 40% of your entire portfolio is going into foundational ETFs. But it's up to you how you want to make that happen. So let's first assume that your entire investing portfolio is $100,000. 40% of that would be $40,000. So $40,000 needs to be in those foundational ETFs. That could be all 40,000 into one foundational ETF, something like VTI, or that could be something like half and half. So $20,000 in VTI, $20,000 in VU, or $30,000 in VTI, $10,000 in VU. Altogether, it just needs to come up with 40,000 in these correct types of ETF for that category. The way you choose to do this doesn't really matter as long as, number one, the funds you are choosing for that category fit the description of what you want for that portion of your portfolio, and number two, the total amount in that category comes out to the percentage you're aiming to hit. So that was for foundational. So now for the other two, you're just gonna do that exact same thing. There are so many super awesome dividend ETFs out there that are intriguing and definitely deserve a shot to get into your portfolio. In this video, I found the 7 best dividend ETFs that I would add to SCHD. And I'll link to that one down below so that later on you can also check that out. And I've done part of the work for you as well, looking at growth ETFs. In this video, here are the top 5.5 growth ETFs that I think that you should definitely take a look at. I did make that video about 5 or 6 months ago and it can probably use an update, but most of those funds are still the top ones even today. A very important thing that you do need to understand at this point is that even if you set up your portfolio perfect and you say that you want 40% in foundational, so you put $40,000 worth of your portfolio into VU and VTI in some way. Just because you start it there doesn't mean that now it's set up that way and it's always gonna be 40%. Because certain ETF categories are gonna grow at a rate that's different than other ones. Like right now, the growth category is going insane, where the dividend or value category right now is kind of lackluster so far in 2023, but it'll come back, don't worry. But something like these growth ETFs, had you had like $20,000 in there to start, you might have something like 25,000 or 30,000 by the end of the year. And so now your percentages are a little bit off. If you want to be a disciplined investor and you know that you want to keep these categories at a certain percentage, at least once per year, and usually at the end of the year or the beginning of the next year, recalibrate. So at that point, you might need to do something like sell a little bit of your growth and put that into the dividend just to make sure things are back to balanced. This is definitely something that you don't have to worry too much about until you have a healthy amount invested. So maybe in your first couple years, you don't even worry about this. You just get money into your portfolio, get it working for you in that compound interest, and then eventually we're gonna even everything out. You definitely don't want your portfolio to be too risky or more risky than what it is that you're looking for out of your investment goals. Watch this video on the ideal percentage of those 3 categories that we were talking about from before. And if you've already seen that one, then definitely check out this one on the dividend ETFs that I was talking about, and this is gonna make that portfolio just grow like crazy.